afternoon, we are the UPT Bankers team, and we're going to present our pitch book and financial analysis based on the company Louis Vuitton. First of all, we're going to present ourselves in order to you to know us better.
Hi, my name is Daniel Maldonado. I am a financial engineer in University of UPT.
Hi, my name is Astra and I'm a student from International Commerce from UPT.
My name is Luciana Jimenez and I am a financial student of the University of Tecamac, UPT.
Hello, my name is Martin Campos and I am a financial engineering student at the University of Tecamac, UPT.
Fine. First of all, we're going to see an overview of the company. And we already observed that the company is the leader in luxury goods with over 75 iconic brands and with a global presence in more than 70 countries that represent a real impact on the luxury market. We observed that its key segments include fashion and leather goods that are 49% of the revenue, of general revenue for the company. It also focuses their sales in watches and jewelry, strengthened by the acquisition of Tiffany last year, and in perfumes and cosmetics. We observed in general that the financial situation of the company is, first of all, with a capital of 344.8 billion euros and a strong revenue growth. Its success is based obviously in a diversified portfolio, vertical integration, and different strategies focuses on sustainability. In the luxury sector, we can see that remains a resiliency with a projected of 4% of compound annual growth rate. In this case, we observe that customer spending in China and the United States in this luxury goods sector is increasing along the years. And we have that it faces some challenges. First of all, the competition. We have Hermes, Kering, and Vuitton, and geopolitical risk and the revolution of e-commerce that represent challenges that the company is going to face at some point. So we have some opportunities that we already saw in this case, and my mate is going to explain you the strategies we're going to implement in order to get more benefits, increase sales, and increase income for the company.
So, move on to the next point. I'm going to introduce the third strategies. The first one is geographic expansion and market diversification. We want with this increase present in Tier 2 and Tier 3 cities in Asia, Latin America, and Middle East. This for capitalize on new source of demand. The second strategy is digital innovation and omnichannel experience. We want with this invest in technology as cognitive artificial intelligence, augmented reality, and data analytics to personalize the shopping experience. So this is intended to signal to our market that we are a company adapted to change while maintaining its prestige and exclusivity.
Likewise, our last recommendation was based on the LVMH annual free cash flow, where we found available to acquisition of targets such as Ethical. But what about Ethical? Ethical is a brand that's been being one of the best sellers in the Chinese market. So therefore, we evaluate the benefit which Ethical could provide to the company. The first one is the sustainability. Ethical could provide sustainability because it works with a lot of ecologist vision. The second one is the portfolio products that are focused on fashion and accessories. The third is the brand is built for the digital era, so it's accessible through e-commerce. Every single benefit of Ethical, even before, brings to LVMH higher profits as well as a good development in the Asian market. But what about the total expenditure of investments in the three recommended strategies? The company has an annual free cash flow of more than 10 billion euros that allows the company to acquire brands which affect significantly their own budget. In addition, its debt is manageable and its profitability is solid, with operating margins of more than 20%. But why not try to expand LVMH? We have 3,600 600 million to invest in strategies, and 1,500 for the geographic expansion, 350 for digital innovation, and 1,400 for the acquisition of brands. We forecast a good competition capital from the strategies.
And in this case, we have made a true analysis through the main financial states, and mainly balance sheet and cash flow, in order to get to know the company better and know if these strategies are going to be reliable for the company. And in this case, it represents a revenue and an income that can be invest or reinvest in the company in these strategies without representing a risk for the capital in general for the company. So the strategies we have talked about in this case, we're gonna be evaluated for a Möet that my mate is gonna be explaining to us, in order to know if they're gonna provide the company income and revenue along the 3 years that are expected to be in these strategies.
In one hand, to demonstrate the profitability of each strategy we set on this case, we got the following results as expected in numbers. For the first strategy, we had 700 million of euros according to our first implementation of this strategy to LMH, and for the second one, we have 800 million of euros, and in the third one we got 900 million of euros for incremental free cash flow for these three strategies. And in the other hand, we also considered another indicator like the WACC, I mean the weighted average cost of capital, taking account the 6% to future plans for the company to make better plans for new partnerships as well. For the new formula we considered is a percent value that is equal to free cash flow increase over the sum of one and the WACC indicator elevated at the number of every year. This is going to be at the short term, and making the sum of these three strategies, we got the 6% discount factor that is for discounting the cost of capital, but this is going to be as an investment for the growing of the company. In the first one, we got 0.9434. In the second, we got 0.8900, and in the third one, 0.8396, getting us at a total of 2,128 million of euros for the investment of this project, taking into account the strategies we proposed.
Okay, and now for the corporate finance advice, we have some important points. First of all, capital allocation, then opportunities, partnership, and expansion strategy. Through the strategies we have been implementing in this case, we need to first of all see that the geographic expansion, it's gonna be implemented, and when this has liquidity, we're gonna have to approach would reward the company's strong financial position. So the financial recommendation is to prioritize allocating capital strategy growth projects initially. Once the benefits are initiated and are realized and liquidity is generated, evaluating additional share buybacks and dividend distribution. For the part of acquisition of Isicle, my mate already told you, we're gonna see an impact or a financial impact and integration. And it's expected to be contribute incremental for FCF about 700 million in the first year, 800 million in year 2, and in the third year we're gonna see or expecting a revenue of 600 million in the third year. Discounting what my mate already explained it to you, and our recommendation is to proceed with the acquisition of Icicle, and this might not only diversify the portfolio, but the revenue is gonna increase impressionably. And the third point, we have that strategic alliances is gonna be really impact in the company in a positive way. They're gonna get into the market of China in a better way. Additional revenue streams without requiring excessivity of capital. In this case, as I already explained it to you, it's not gonna represent a risk for the capital market in the company. So they are reliable, and the company needs to focus on that to get more revenue, more profits in the next 3 years.
So finally, I'm going to introduce the risk assessment. So I'm going to tell you what is the main risk, and then I'm going to tell you what is the mitigation that we want to use. So remember that the one strategy is geographic expansion and market diversification. So the main risk that we have or we consider is cultural, economic, and regulatory uncertainties in emerging markets. The second one is volatility of local currency and macroeconomic risk. So then we have some mitigations, and is conduct market studies at Pesto analysis to understand the specifics of each region. The second one is establish a strategic alliance with local partners. The third one is use currency hedging to mitigate each rate risk. And the last one is adapt the product offering and marketing strategy to each market. So the second strategy is digital innovation and omnichannel experience. The main risk that we consider here is rapid technological evolution to make render invest obsolete. The second one is uncertain rewarding consumer adoption to technologies such as artificial intelligence and augmented reality. And the last one is cybersecurity risk and challenge in complying with data protection regulations. The mitigation that we consider here is first one, implement pilot project to validate new technological before a full-scale rollout. Second, select technology partners with experience in luxury factory sector. Third one is invest in cybersecurity and international training to ensure regulatory compliance. And finally, monitor the adoption of new technologies and adjust the strategy based on results. The third strategy, as we remember, is potential acquisition targets. Here, the main risk that we consider is, first one, is difficulties in cultural and operational integration between companies. Second one is risk of cannibalization of conflict in brand positioning. And the last one is regulatory barriers and conflicts in obtaining approval for the acquisition process. The mitigation that we select here for the main risk is, first of all, conduct thorough dual linguing to identify potential issues before the acquisition. Second one, develop an integration plan with clear milestones and definite responsibilities. Third one, utilize specialty M&A teams to observe the process of the company of this acquisition. And finally, include contract classes that protect the invest and ensure the achievement of expected synergies. So that's all the analysis that we get here, and we forward your answer. Thanks for the attention and your time.